This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
On today's Bloomberg Intelligence Show, we dig inside the big business stories impacting Wall Street and the global markets.
Each and every week, we provide in-depth research and data on some of the 2,000 companies and 130 industries our analysts cover worldwide.
Today, we'll take a look at how one company is looking to fix your terrible board meetings.
Plus, we'll discuss how the energy transition will drive a significant uptick in demand for metals.
But first, we got the Olympics coming up this summer in Paris. How cool is that going to be? But good luck trying to get a hotel room there or trying to get accommodations anywhere. You know who would know about this stuff? Airbnb. Dave Stephenson joins us. He's the Chief Business Officer for Airbnb. Dave, talk to us about your business in Paris for this summer. What are you guys seeing?
You know, one of the great things about having Airbnbs in Paris is that the volume of Airbnbs have gone up pretty dramatically. We have 40% more active listings than we had a year ago. And by having those extra listings, we're actually able to keep prices reasonable because we're able to add so much capacity to the stays there. So there are still places available. You know, we're only 24 days out, but you know, you can keep booking. There are Airbnbs ready for guests to come from around the world.
Yeah, because you know why? Everyone's leaving Paris.
Yeah.
All the Parisians are like, get me out of here, and they're going to the south of France. Anyway, sorry, go ahead.
So, Dave.
Well, it's not bad. They're actually able to earn, 2,000 euros on average for a host in Paris. And so, yeah, many people do leave and share their homes and welcome people from other countries to come to the Olympics.
Talk to us about where you're seeing travelers come from to Paris.
Yeah, it's interesting. Some of our top countries are the U.S., UK, and actually people from other areas of France coming into Paris for the Olympics. We're also seeing some interesting trends where people are staying. The Olympics are actually not only in Paris, they're kind of spread around the country. And so, we're seeing people staying in Airbnbs in Lille, where some of the basketball is being played. We're seeing them in Lyon, where some of the football, soccer matches are being played. You're seeing Spaniards and Brazilians stay in Bordeaux because their national teams are going to be playing soccer out there. So we're not just seeing people come in Paris, they're staying in Airbnbs all around the country.
That's interesting. I did not know that. You also transitioned recently from CFO to CBO. Is that so? Chief Financial Officer to Chief Business Officer. How is that? How does your job change with that title?
Yeah, no, I'm the Chief Business Officer. I'm also the head of employee experience, so the head of HR, which I've been doing now for 3 years. But the Chief Business Officer, I'm focused on growth of the company and expanding into new business areas. So we're expanding beyond the kind of core stays business here at Airbnb into things like services and experiences over time. And so me and my team, that's what we're focused on, growing the existing business and expanding into new ones.
So for just the business in general, how is travel, this business, as we crank up here in the U.S. for 4th of July? And then, of course, in Europe, they have their big travel during the summer, particularly August. Give us a sense of kind of where you're seeing the business these days.
Yeah, we're seeing more people travel this summer than they ever have before on Airbnb. Continue to see great growth. Yes, strong growth, especially from Americans traveling to Europe. We continue to have a strong dollar, which enables strength there. And we're actually seeing, nice strength in people even traveling from U.S. into Asia.
U.S. into Asia. Okay.
Which is that ripping dollar.
Yeah, you can go anywhere pretty much.
Against the yen.
What about the opposite? Is anyone coming to the U.S.? We making any money on Airbnb here in the U.S. anymore?
Absolutely. I mean, people are still traveling from overseas in the U.S. Actually, the majority of our travel still is actually domestic travel in any given country. So we're kind of talking a lot about people moving around the world. But a lot of the travel is just people going, in the U.S., it's a lot of beach destinations. You're seeing great travel down to Florida, up onto the East Coast, onto the Jersey Shore and other places. So, people are still traveling out to the beaches to visit with family and enjoy the 4th of July.
Dave, what's a typical or prototypical Airbnb customer look like?
We have customers of all kinds. It's everything from young Gen Z millennials to families. A large number of our people in travel and Airbnb are group travel, multiple people traveling together because you get more space. You might get multiple bedrooms, you have multiple amenities, often with a kitchen, maybe a washer and dryer. It's one of the reasons why we recently launched some of these group travel features to enable more people to stay together more easily. We have things like shared wish lists, shared messaging capability, and that's helping in Paris, where over 50% of the people traveling to the Paris Olympics have 3 or more people. And so the group travel is a key benefit of staying on Airbnb.
That's a good point. What are other trends that you think you're going to be dealing with in 2025, kind of after we get through the Olympics?
I think we're going to continue to see strength in travel. I think one of the things we've seen since the pandemic is that people realize how much they miss being able to kind of travel, be with family and friends, that experiences are maybe more important than things. I think that trend will continue, and we're going to see people wanting to spend time with family and friends doing things together. So I think that's the big trend that we'll see in 2025, continued experiences.
Our thanks to Airbnb Chief Business Officer Dave Stephenson.
We now move to the cloud space. Zeck, a cloud-based software company, is now trying to fix any potential dread you may have for an upcoming board meeting.
The company distills hundreds of pages of corporate documents into interactive websites for boards to expedite meetings, and even has an AI product. And recently, Zeck announced it closed a $7.5 million investment led by Salesforce Ventures.
For more on all of this, we were joined by Zeck co-founder Edward Norton. We first asked him more about what Zeck is trying to do.
We're trying to make the experience between management of organizations, and I say that meaning corporations or nonprofits, because obviously we've got a couple million nonprofit organizations in this country that have governance and boards and stuff like that. We're trying to take what we feel is an increasingly toxic dynamic and reform it into being what it's supposed to be, which is a relationship that propels an organization, supports, brings additional leverage, positivity to an organization. And we, I've definitely had some people say to me, like, you have an interesting day job. Why would you get involved in
And your day job, just for folks that on the radio, Edward Norton, actor's been in a bunch of movies and all that kind of stuff.
Yeah. And I will admit that, on the surface, like a software platform for board governance features seems pretty esoteric, but it grew out of my own experiences over the last 30 years, not dissimilar to yours, from serving on the board of arts organizations, serving on conservation organization boards, and then as I built my own companies, and I've built a few software companies that we had our own boards, people like Fred Wilson from Union Square, or Axel or Greylock, or these firms. We were on the management side, and we were experiencing what it meant to have a board. And then when I sold one of my companies and I joined the board of GoFundMe, the company that acquired us,
cool.
I started sitting on corporate boards, and my partners and I really started feeling that there was this elephant in the room, which is that companies go through 4 to 8 times a year. They go pencils down to get ready for this thing that essentially to them feels like a hall monitoring moment. And board members, on the other hand, when I was a board member, 36 hours before the meeting, you get a 90-page PDF, and you're supposed to read it in the airport terminal, and then you go to the meeting and get it read back to you. You know what I mean? Like there was just, and
so you're looking to make it a more interactive, visual, engaging experience.
I think we say 2 things. One is quantitatively, board meetings are an enormous waste of time for everybody. And that has to do with the amount of redundant time waste on setting these meetings up and the presentation materials. And that can be crushed down by having cloud-based, AI-powered tools that make it like 1/10 the time for a company. On Zeck, a company can set up for a board meeting in 1/10 the time that they were using to prep before it. Board members should get to read something that's, you wouldn't read the New York Times or Bloomberg on a PDF. You read it in a mobile friendly scroll, right? That we expect that now. And so everything about the user interface should be easier for both sides of the table. But also think about this. Think about how much time, how many professional, talented people whose time is valuable sit there in board meetings approving minutes. Approvals, approving stock option packages, things that they ought to be able to do from the airport lounge in advance. So we built governance function that can be interactive and mobile and all of it.
So your customer is the board.
The customer is the company and the board.
Okay.
Yeah, but both sides, management and board members, suffer in different ways, and we've tried to reform it. But when you crush the redundant inefficiency of time waste, you improve the quality of the meeting too, because a board meeting should be a forward-looking experience, not a, you don't want to spend hours looking backward. Everybody can ingest the looking backward part before the meeting. You want the meeting to be propulsive and additive to where the company or the organization is trying to go. And the best thing about what people are saying to us is not just, oh, we really love the user interface, it's much easier, it's easier to read. We love that they're saying to us, this has radically improved the quality and the value of the meeting itself and what we're getting out of our board.
So you guys just raised about $7.5 million Series A led by Salesforce Ventures, including some other guys as well. What are you going to do with it? And what's sort of your end goal here?
Well, I think if you look at, first of all, Salesforce to this day is still, they still are the greatest innovator in cloud-based corporate tools. And I've known Mark Benioff a long time, even though I never told him that we were doing this with his own team until it was done, because I didn't want to, I didn't want it to come from the top down. The Salesforce team is really phenomenal. But, our fantasy was to work with Salesforce because really nobody understands the business of cloud-based corporate tools better than they do. And I also like their ethos as a company. I think they have a great customer service ethos there. But, if you look at, think about today, would you ever get a FedEx package with signature tabs on your legal documents? No, you get it in DocuSign now, right? You don't manage your cap table in Excel spreadsheets anymore. You use Carta. And we've made this evolution toward lots of aspects of corporate function have gone into the cloud, but this really critical function hasn't. And we think that on a business level, to be honest, if you look at Carta, which is a $7 billion private company, and DocuSign is a $15 billion public company, there's an enormous market in relatively low-priced corporate software tools. And we really thought this was a good business. We think there's a very large marketplace of companies and nonprofit orgs that need to reform this critical piece.
Our thanks to Zeck co-founder Edward Norton. Coming up, we're going to break down the Supreme Court decision to overturn the Chevron rule and how that could put climate targets at risk.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney.
And I'm Alex Steele, and this is Bloomberg.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Last week, the Supreme Court overturned a 1984 decision known as the Chevron rule that experts say will make the EPA's job to regulate methane and carbon dioxide emissions more challenging, potentially putting U.S. climate targets at risk. For more, we spoke with Bloomberg Intelligence Senior ESG Climate Analyst John Stevenson.
If you think about the Clean Air Act, that's the biggest thing the EPA has ever done. It started in 1970 with one document that said basically go to it. We need to reduce the amount of air pollution in the air. We need a lot of different levers to pull to make that happen. We're kind of deferring to experts to do that. And, they did it for about 20 years, and then they had another revision, Clean Air Act 2, and that's the one that we're enjoying today with when they basically said you did a decent job, let's keep going. Let's keep driving down the air pollution. And, here we are today with the cleanest air we've seen in since the early 1900s, basically. Well, so it's been very, very successful.
Yeah, I'm not that old, but I remember first going to Los Angeles earlier in my career, and you could see the smog. Literally, it was brown, it was orange, kind of funky. Now you rarely, if ever, have any problems out there. So I kind of have been a fan of the EPA. Given this Chevron ruling, what does it mean for climate in your part of the world? What's it mean for the energy industry?
It's troubling on a couple fronts. The first is with respect to the oil and gas industry. The big oil companies have done basically a fantastic job of driving down a big chunk of their pollution from methane. So methane is really the thing that you really want to address when it comes to the oil and gas industry, which is just sort of leaking natural gas into the atmosphere. And the bigger companies have done a fantastic job, but the smaller companies basically, or the private companies, haven't moved on it. And so the leadership we've seen from ExxonMobil and others has been really transformative in terms of what's happening for the bigger companies. But unless the EPA does work to kind of push along the rest, and we're talking about still half of the production comes from small companies that are private, we're not going to get anywhere near where we need to go on from an emission standpoint from the oil and gas industry. So that's sort of one. The second is really with respect to the power sector. So the power sector, we need more power. We've basically gone from having a coma power growth over the last decade, and now because of AI and EVs, we have power demand somewhere around 2.5% a year. And that has to be filled with something. And it looks like gas is going to be a candidate in the next several years because there's just so much demand that needs to come online. And there was a ruling, at least from the EPA, that the gas companies, if they were going to build a new power plant, would have to capture that gas, and that doesn't look like it's going to happen. So, because of the ruling.
I mean, the power coma, that was actually a great. I'm going to steal that. I hope that's okay. So, you were ESG climate analyst, so that's environmental, social, and governance. Does the social and governance part of your job get affected by the Supreme Court decision?
Well, so some of the people think of the environmental, it does include chemicals and things like that, and obviously that's going to be a bigger problem. The social, if you think about health, that's really what's going to happen with respect to this ruling. So we are going to have poorer health. I mean, the ability for judges to make decisions that are very complicated. I mean, you're talking about, I just mentioned the Clean Air Act. That's a 50-year project with thousands of people working on it, and to have an opinion on how to get from A to B. And we are now expected to have judges have an opinion that is just wildly professional in a number of areas, and that includes things like PF, the kind of forever chemicals, so that's going to affect health and food safety. So there's a lot of things on that side that are going to be affected as well.
So do we have any experience on kind of how this works outside of the regulatory agencies? Are the judges, are they making reasonable rulings when applicable?
So yeah, the pushback was that these are the judges and the agencies. There's no interaction, and there's quite a bit that goes on. And I think the agency will only win about 70% of the time. So the judges actually have had input into this, but you're really relying, and it can swing both ways, which is the really kind of counterintuitive part, is that you could have a judge that decides it needs to be more stringent. Right, so it can go in different directions, and I mean, it's ultimately been deferred to the Chevron defense, and they say, okay, we'll let the agencies deal with it, and now we have that kind of open terrain. So it's very difficult to see how things move as smoothly and in such an organized fashion as we've had previously.
Yeah, because the other side will say, well, judges do this all the time. Like they're ruling on different cases that they don't have an expertise about all the time. What's the difference? For the companies that you cover, which companies will be most impacted?
So the companies that are really, if you think about what's going on with the growth of let's just talk about power for a second. The companies that are really taking up a challenge with respect to power demand going up and dealing with it really on a kind of the clean energy front, there's two benefits. You get paid for CapEx, right, when you're a utility company. So the more of that CapEx that goes into renewables and grid and things like that, you get basically 100% of that money is you can earn a return on it. Whereas if you build a gas plant, you only get about half that because half of the cost of the plant is in fuel, and you don't get paid for that as a utility. So the companies like Constellation Energy are still expected to do very well. NextEra Energy, because of the IRA, are getting very strong incentives to continue to produce as much clean energy as they can, and if you look at their stock prices, they've reflected that in the last little bit. But from the other side of the equation, which is the oil and gas industry, the leaders are already the leaders, and they've performed exceptionally well. If you look at the group that is the lowest methane producers, have done very, very well against their other guys.
Our thanks to Bloomberg Intelligence Senior ESG Climate Analyst Andrew John Stevenson.
We next take a look at the Swiss company ABB.
ABB is a technology leader in electrification and automation, enabling a more sustainable and resource-efficient future.
Guest host Jess Menton and I were joined by ABB Chairman Peter Voser. We first asked Peter where the focus of his company is these days.
It's the energy transition, which is not only the hard-to-abate sectors, it's in general the move from a more fossil-driven energy system into electric energy system. And there we obviously contribute with our products and systems, which gives us energy savings between 20 and 40 or even 50%. So that's one angle. The other one is all linked to new technologies around automation and robotics, because we are a world-leading company in both areas. And that has to do with the reshoring, bringing things closer home again, where the markets are, but also in some countries dealing with the demographics, because we have less and less people working in the working age, and therefore robotics and the automation becomes very important. And the last one is AI, which will revolutionize, obviously, all what's related to automation in the future.
Well, talk to us more about what you think is the best way to try to scale manufacturing when it comes to the EV charging space.
I think what we really need on the e-mobility side, let me put it this way, is really work on two fronts. One is the technical side on the charging side, but the other one is also on the user friendliness side, so that they become actually more reliable, they are much more modern. On the manufacturing side, I think we have had clearly in some countries and regions, there was some scarcity of manufacturing capacity, which I think have been solved. Was not an issue for ABB in that sense, but it's the product evolution which is very key. Now, on the other side, I think one should not forget that the whole network of electrification needs to be up to speed. You cannot just actually consume much more energy. You also need to build the transmission lines, that the power actually comes in where we have got let's say the chargers installed, either for private passenger cars or for buses, ships, trains, whatever you want to call it. So I think we need much more infrastructure investments on the one side in really to actually get the EV charging and the passenger cars based on electrification much more developed in the future.
Peter, who are some of your bigger customers that you're working with these days?
We are here in the United States, so we have all kind of manufacturing companies in that sense. But on the industrial side, any company you can think of, they are in manufacturing space, for example, they use our electrification products, they use our automation products. So you have all the industrial companies, and that's where we make the difference. On the other side, utilities are very key. As I just said, they need to make sure we have enough supply.
And I know I'm just looking at our PGEO function where I can see where your revenue comes by geography. You're everywhere. Do you see certain parts of the world that are more in front of, kind of making the transition than some others?
Yeah, I think I would say that Europe has started this rather early, with the new Green Deal in Europe, but also moving into very different energy systems. Paid some price with the wars in Russia, so energy prices have gone up, and some rethinking has taken place. I think here in the US, you quite clearly see the demand is there in all industries, now supported by the various acts you have. Here, either the Inflation Act or then also the Industrial Act, and that is driving investments now. It's much earlier days than in Europe, for example. Asia is a little bit a mixed bag, I have to say. So you see some countries at the leading edge, like smaller countries like Singapore. In China, which is our second biggest market after the US, you see actually a lot of efforts now being put in place to change the electric system in China. A lot of EV cars are coming in, and you can see that those really are now generating the growth in China, whilst it is subdued compared to the US at this stage. So indeed, we are operating across the world in more than 100 countries. We get good insights. At the moment, the driving forces are really the US and Europe, with, let's say, Asia, apart from India, are lacking somewhat.
So where else do you go to expand from here when you already are in so many places?
It's quite clearly US is our key number one market, and that's where we are developing. We have, over the last 10 years, we have put more than $14 billion into the US in terms of investments. We have got 40 manufacturing sites in 20 states. We're operating in all states with our services, etc. So that's a key market. We see the electrification market in the US as key, but also the industrial one, which has a lot to do with bringing home, let's say, manufacturing capabilities and capacity. And then the second one is clearly India, which at the moment is, in terms of growth, outstripping all other countries in a big way. They are very low in manufacturing capacity, and that's where a lot of investments now for the high-end manufacturing goes in. And then the third one would be Europe, quite clearly, as the European change in the energy system, but also the demographic issues which we have in Europe, which will take out, 50 million kind of working people over the next 10 years, and that needs to be replaced by automation and robotics. So there's a lot of investments ongoing there.
Thanks to Peter Voser, chairman of ABB.
Coming up on the program, a conversation with Nextera Energy CEO John Ketchum on how the demand for power is dramatically increasing.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney.
And I'm Alex Steele, and this is Bloomberg.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
We begin with a look at the company Nextera Energy. Its ticker is NEE. Nextera Energy is a leading clean energy company headquartered in Juno Beach, Florida, and it provides clean, affordable, reliable electricity to approximately 5.8 million customer accounts, or more than 12 million people across Florida.
For more on how the demand for power is dramatically increasing, we were joined by Nextera Energy President and CEO John Ketchum. We began by asking him more about what his company does.
We're made up of two businesses. One, we own the nation's largest rate-regulated utility, Florida Power and Light. Mm-hmm. And two, we are the world's leader in renewables, wind, solar, battery storage, a unique combination bringing those two companies together.
But you still have like nuclear and gas too, right? Like
we do.
For the utility side.
We do. So we cover it all. We're in every part of the energy value chain, not only renewables. We have 6 gigawatts of nuclear, and we're one of the best operators in the country on the nuclear side. And we also own gas-fired generation. 72% of our generation fleet in Florida is actually natural gas fired. So we view ourselves really as a very credible source in being able to advise our customers on what the lowest cost option is for generation.
Owning a electric utility in Florida would seem to be a tough business with all the weather down there. What happens when these storms come through? How do you guys, you have to almost be in a constant state of emergency almost to be able to react.
We are battle tested. That's one of the great things about our company is that nothing catches us up by surprise. And it comes from a culture of continuous improvement and innovation. And we practice and we drill. And we've had, 49 hurricanes in the last 20 or 30 years. We're never caught by surprise. We're a company that is used to managing through diversity, and that's one of the strengths.
So you mentioned catch by surprise. So there was an investor presentation that you made, and where you outlined your forecast this year through 2026. Your also 2027 midpoint profit forecast. That's the one that analysts said that falls short of our estimates.
Yeah.
And I guess the question is, if data demand and data power is going to drive so much demand for your stuff, why isn't that midpoint higher?
Well, here's what we see, and we talked a lot about this at the Analyst Day. There are 3 things that I think really differentiate Nextera as part of our value story. 1, we're seeing an inflection point in power demand. 2, it's going to be met by renewables because it's low cost, fast to deploy, and it's clean. And no company's better positioned to meet it than we are. And our business model has always been in what I would call a replacement cycle. We are building new renewables to replace higher cost coal plants, higher cost, less efficient gas-fired units, oil-fired units. We now have this new opportunity that's really emerged in the last 6 to 9 months, which is what I call our growth cycle opportunity. It's a new demand that has come, and it's across industries. It's not just data centers get a lot of discussion, but it's industrial electrification, reshoring to manufacturing as well. But when you think about it, we're having all these discussions with these customers now. I'll take data centers, for example. It takes 2 to 3 years to build a data center, so they won't need the power until 2027. We might sign a contract today, but the power comes in 27, which means it contributes in 28. And so what we're trying to explain to investors, look, we have a tremendous long-term growth outlook, but a lot of this growth cycle demand is really going to start materializing and producing revenues and earnings in 27, which means it really starts to contribute in 28.
As you walk through Midtown Manhattan, you probably see some empty office space here. I think they all moved down to your state. Talk to us about how that's impacted your business in terms of demand and maybe what you have to invest back into your grid.
Yeah, and that's what's great about our business, right, is the barbell approach. We've got the nation's leading rate-regulated utility in Florida and the world's leader in renewables. In Florida, we're seeing tremendous growth. Over the next 20 years, we're projecting a 44% increase in GDP. We have 1,000 people a day moving to the state of Florida. 4 of the 5 fastest growing metropolitan areas in the United States are in Florida. If Florida were a country, it would have the 14th largest economy in the world. And we're there to power all that growth. So our growth story is not only about what I just discussed about all this renewable demand that we see powering AI and industry and manufacturing across the United States, but it's also all the growth that we see right in our own backyard in Florida.
Talk to me about rates. So you're going to need to invest a lot, right? Like there's going to be an enormous investment cycle, as you mentioned, like the growth cycle for utilities, right? What is it like on the regulated side of going back to the government and saying, okay, guys, I got to invest it. You got to raise the rates.
Yeah, and so what we do is we have done a terrific job of taking cost out of our business. So when you look at what we've been able to do over the last 20 years, our O&M on a dollar per megawatt hour basis is 70% lower than the national average. That's $3 billion we put in our customers' pocketbook every single year compared to an average utility. And we've always been able to make really smart capital investment decisions around bringing low-cost generation into the fold. And the lowest cost generation option that we have in Florida is solar and storage. So although we're investing more capital, it's actually lowering the bill because it's a lot cheaper than other generation alternatives, combined with our ability to take cost out with the way we operate.
But from your investor's perspective, is a unit of power from a renewable source, what's the profit margin on that versus maybe an existing source?
Well, when you think about renewables, I mean, renewables, have really strong returns. And they're low cost, and you talked about interest rates being one of the factors. We pass those costs through to our customers, and so the cost of wind and solar has gone up a little bit as we've seen some pressure here from the macro environment. And so have cost increase for every other type of generation. Actually, gas-fired generation has really gone up in price. And so, what we have seen with gas-fired technology is a 50% increase in the last 12 months. That has not happened to renewables, making renewables even lower cost than they've ever been on a relative basis to gas turbine options.
So what I hear is that everything is just more expensive because that's the environment that we're in. But because you're able to take costs out, the rate payer may not get hit as hard. Is that a fair statement?
That's exactly right. And so what we've been able to do in Florida, our bill is 37% lower than the national average. 37%. It's because of our ability to take all those costs out of the company and also offer them low-cost renewable solutions as part of the generation mix. And when you put those two together, that's how we're able to achieve that 37% lower bill than the rest of the nation. That's a really compelling customer value proposition and investor value proposition.
Our thanks to John Ketchum, President and CEO of Nextera Energy.
Staying with energy, we have something here at Bloomberg called Bloomberg New Energy Finance. The idea behind it is to provide data on commodities, power, transport, industries, buildings, and agriculture, plus new technology.
This week, we looked at how the energy transition will drive a significant uptick in demand for metals.
BloombergNEF estimates $6 trillion worth of key metals will be needed between 2022 and 2050, and to reach net zero emissions by mid-century, that number leaps to $10 trillion.
For more, we were joined by Sung Choi, Bloomberg BNEF metals and mining analyst. We first asked Sung to comment about the amount of metal that would be needed in the energy transition.
As we progress through the technologies where we shift from fossil fuel to clean energy and with the innovation in technologies, especially in the transportation sector and data sector as well, and power grids, more metals will be needed. In order to get the electrons flow, you need metals. That's pretty obvious, right? Now, the particular categories of metals that are of interest lately is lithium and copper. Those two metals are very interesting at this moment.
Where do we get these metals, and is that a concern where we do get them?
Yes, that is a concern. So for me, demand is of a concern, but it isn't too much of a concern. Supply is more of the concern. The reason for that is, the reason that I say that is because many of the places that have this particular resource, such as copper and lithium, are in areas where it has very sensitive political and social landscape. And in order to get those supply out of the ground, right, miners have to navigate through those complicated situations, right? For example, many people forecast that the copper will be in surplus for 2024.
Will be a surplus?
Yeah, it will be a slight surplus for 2024. That was the expectation.
Okay.
But then at the start of this year, right, in Panama, Cobre Panama was shut down for many reasons, right? As a result of that, we're experiencing this run up in copper prices,
right?
Because there's a dislocation between copper mine supply and the smelter capacity.
So here is where I think raises the problem, because you're looking at a structural shift among metals that are cyclical. So that's one area where we were surprised to the upside, and now we're going to see a deficit. But then I look at lithium, and we knew the EV revolution and the batteries, we were going to need lithium. So all of a sudden, the lithium guys, and a lot of them are in South America, went gangbusters. They're like, we need all this lithium. It's going to be awesome. The demand's going to be there. And then the prices crashed. And then they had to shut down some of their operations because it wasn't economic anymore. We do need the lithium,
right,
but we didn't need it that day.
Yeah.
How do we manage that?
With everything, timing is everything, but it's really impossible to predict any type of timing with any type of investments, right? So copper is in its moment right now. For lithium, that was 2 years ago, right? All this hype around electric vehicles, use of lithium, difficulties in getting lithium. So all the investment poured into lithium space, and as a result of that, there's an oversupply issue with lithium, right? But despite the oversupply issue, the lithium industry is at the cusp of a paradigm shift in technology innovation, right? There's this thing called direct lithium extraction technology, where you take the
direct lithium extraction.
Yes, direct lithium extraction technology. So there's two routes where you could extract lithium. There's mainly hard rock lithium, where you take the spodumene, you mine it out of rock, and you process it. Other process is brine. You take the brine and you extract the lithium out of it. But
water. Think water,
yeah,
basically.
Yes. Okay. But using evaporating method. So you're using sunlight to evaporate the water out of it and extract lithium. And that takes 2 years. Now DLE, or direct lithium extraction process, that's gonna bring that lead time down to 2 weeks instead of 2 years.
Oh.
So main competition versus hard rock. That is, right? Now that's going to be a game changer for the industry, where it's going to actually lower the cost curve. It may lower the cost curve. It's a bit too early to tell right now, but at the cusp of commercialization of this technology, it may lower the cost curve, and it may change the industry forever.
Our thanks to Sung Choi, BloombergNEF Metals and Mining Analyst.
That's this week's edition of Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies in 130 industries.
And remember, you can access Bloomberg Intelligence through BI Go on the terminal. I'm Alex Steele.
And I'm Paul Sweeney. Stay with us. Today's top stories and global business headlines are coming up right now.